All right, welcome to chapter 42. This is going to be the last of our chapters that we're really covering inside the corporate structure. We're going to move on. I think the next chapter, if I'm not mistaken, is administrative law. This one is a little bit long. It's got some tech terminology, I think, that can be a little confusing to the average student. There's going to be a few things at the beginning here I think you need to pay particular attention to. And in particular, keeping straight the difference between 1933 and 1934 legislation. I know that sounds, that's 90 years ago for most people, but these are those two pieces of legislation, the one passed in 1933, the Securities Act, and the 1934 Act, are very, very important. So first, a little bit of background, a little bit of history here to kind of set the stage. If you look at the stock market prior to 1929, which everybody I think knows is the stock market crash. Prior to 1939, I guess you would call it an extreme free market, in which there was little or no regulation of what was going on inside the stock market. Part of that, I wouldn't say completely, but part of that contributed to the collapse of the stock market in 1929, where you saw a massive loss in the amount of equity. Now, many people conflate the stock market crash in 1929 and the Great Depression, and they're certainly related terms, but one did not necessarily trigger the other. In the sense that the Depression created the stock market crash, the stock market crash alone created the Great Depression. It was an influence of it. Much of the influence, though, of the Great Depression was really a credit crunch, which was indirectly driven by this crash of the market. And simply what happened was, when the market crashed, a lot of the capital was drawn out of the American economy because it was either wiped out or people were afraid to spend it or wouldn't invest it anymore. The end result was there was a great crisis you no longer could borrow money. And you might say, well, I don't borrow money every day. What's the big point? Well, you also have to remember, if we take home sales as an example here, prior to the 1930s, home sales and mortgages on homes often work like this. You went to the bank, let's say January 1st, and you said, I need to borrow $10,000 to build this house. Fine, we'll lend you the $10,000, and in a year, we will look to see if you're still a good risk, and if you are, we will renew your note, and if not, we will call your note, and you pay us back the money. Okay. So when the stock market crash comes, and people all of a sudden want money and are worried that people can't pay, if you owed $10,000 to the bank might say, okay, we want the money. And you might say, well, the money's in the house. I borrowed the money. And the bank would say, well, I'm going to foreclose in the house. That's where you get a lot of these foreclosures. And of course, this starts a vicious cycle. So the stock market crashes in 29. We have this credit crunch that hits. But there's very little reaction from the government. On any sort of massive scale. And the reason for this is, in 1928, the President of the United States was Herbert Hoover. He just won election. He was widely popular. The Republicans dominated both houses of Congress. It was really a Republican decade, the 1920s. So 1930 rolls around, and the Republicans get shellacked at the midterm elections. 1932 rolls around, and they lose the White House, and we have the election of Franklin Delano Roosevelt. It's only with the election of Roosevelt, so that now the Democrats are going to control the two major branches of government, the legislative and the executive, not yet the Supreme Court, that we begin to have action in these marketplaces. You also begin to have things like 30-year mortgages and what will become, the federal guarantees of mortgages. So in 1933, one of the first pieces of this pie gets put into place, and this is that first piece of legislation, the Securities Act of 1933. Now, what it does is it only regulates, and we'll look at it more in a second, it only regulates new stock being offered. It's not till 1934, because they had to look at this for a while, that they begin to regulate all the trade. Now, One of the smart things they did in both of these acts, 1933 and 1934, is they decided they were not going to say we regulate stocks or we regulate bonds. Because what would quickly happen is people would create instruments that are sort of like bonds or sort of like stocks, but weren't called that, or had some of the attributes of both. And then they would say, well, we're not subject to your regulation. So what the 33 and 34 Act did is they created very, very broad definitions of what a stock is, or what we call equity, or what a bond is, and what we call debt. So that no matter what you created, okay, you're still going to be under the 33 or 34 Act. That's important because, like I said, we just came out of the chapters with corporations. And you can see how, corporations started off in one form, partnerships in one form, then you begin to see all the different forms they could take, just slightly different from each other. Okay, well, the real watchdog here is, of course, the Securities and Exchange Commission. This is set up by the 1934 Act. And this is an administrative agency, and we're going to talk more about administrative agencies in the next chapter. But basically, the Securities and Exchange Commission was set up first really to be a watchdog. It was going to require that information be provided. It was going to regulate trade. It was going to investigate fraud. It was going to register brokers. It was going to supervise mutual funds, and it was even going to, in its controlling of fraud, operate semi, quasi, somewhat official courts. More about that when we get to administrative agencies. Now, I think, like many organizations, it started off very much a watchdog. I think what can happen, and maybe this has happened with the SEC at certain points, is it winds up not being a watchdog but a lapdog. So it's more interested in protecting the business it's regulating than regulating the business that exists. Okay, so what can it do as far as regulations? Well, of course, the regulatory power of the Securities and Exchange Commission is controlled by the Congress, congressional acts. And little bit, what tends to happen is it's a bit of a cycle. If the market gets out of hand and there's a collapse or corruption, that it's exposed, like Sarbanes-Oxley or things, Congress gives the SEC a little bit more power, or tells the SEC to do a little bit more things. Congress also can go the other extreme. It can say, well, we want this part of the market to be freer, so we're going to exempt certain things, we're going to exempt certain regulations. So the SEC, even though it's a creature of Congress, is very much beholden to Congress and can be modified or changed according to congressional desire, with presidential approval, of course. Okay, in 1933, we have the Securities Act. So what it does is it governs the issuing of any new stock by corporation. Now, as I said, it actually says any new security, not just stock. So what they came up with was what was called the Howley test, sometimes called the Holy test, but the Howley test says, is it an investment? Is there a common enterprise? Do you expect profit? Are you going to derive income substantially or primarily from the efforts of another? Then it's a security. And you can see that you can create things that are sort of bonds, sort of stocks, a little bit more, a little bit less, but they're all very much going to fall inside that. So this test works pretty well. And what this meant was, if you had a corporation already in existence, like General Motors, okay? Well, General Motors has been around since the early part of the 1900s. So it didn't affect General Motors stock because it was already issued. Now, maybe if they issued new securities, a different story. But Tesla, which wasn't created until the 2000s, almost 100 years after GM, probably 100 more years after GM, they're going to be subject to the Securities Act of 1933. Now, we're assuming that you're actually going to do this on one of the stock exchange across state lines. Section 5 is your registration statement. All securities that you're going to buy and sell, unless they fall under some exemption, have to be registered. So we ask, what are you issuing? Is it Class A, Class B, par, non-par? Describe your security. What is your business and what are the underlying properties of this corporation? Who's your management? What's the management structure? Then, and this is the one where there was some problems, to be honest, give me a financial statement. Give me an independent accountant firm that has looked over your books and said, this is a good statement describing how much assets you have, what you're doing, are you making a profit, things like that. Now, part of the problem with that is because these independent audits would be paid for by the companies, sometimes there was an incentive for accounting firms really to not cook the books directly, but look favorably upon things. Also, registration or Section 5 requires that you describe any sort of pending lawsuits that are ongoing against your corporation. Okay, um, these are a dying thing, but I'll mention them: red herring and tombstones. Prior to approval, you can actually go out and solicit money by sending out a proxy or prospectus that's not approved. It's called a red herring. You can put advertising and special ads called tombstone ads in certain papers or online. In 2005, the SEC kind of caught up with the 21st century, and you have what's called the free writing prospectus, where you can direct people to the SEC's website and do a lot of this. Um, the registration statement is not effective until the SEC reviews and approve it. Now, during the pre-filing period, okay, you can't do anything. So until you file your registration, you can't buy, you can't sell, you can't get people to promise they're going to buy or promise, you can't do anything. After you turn it over to the SEC during the waiting period, you can go out there and offer it for sale, but you can't actually take the money until, and this is usually the free writing perspective, until the SEC approves. After it's reviewed, after it's approved, now this is called the post-effective period of the registration. Now you can buy and sell this stuff. Um, Well-known seasoned issuers. What we allow, or what the SEC allows, is if you already have at least $1 billion in securities issued in the last 3 years and $700 million in stock issued to the general public, you've got more flexibility in issuing new securities. We're going to assume if you're that big, this is kind of the disease, too big to fail. Once you get big enough, the SEC is going to assume all sorts of things. They're going to say, okay, we're going to assume that yes, um, you can issue stock, you can sell stock outside of the regular process. But as none of us probably have $1 billion in security or 700 million in stock, not an issue that we're going to have to address too much here directly in business law. All right, now, one of the things that the Act did was it exempted certain stock, it exempted certain, I should say securities, I keep saying stock, it exempted certain securities from being covered under this, sometimes because they were registered elsewhere. So governmental securities, obviously if the Treasury comes out with new securities, they don't have to do this. Certain banks and financial securities as they're issued, commercial paper that is less than 9 months, charitable organizations, railroads and trucking firms, they're going to be regulated. At this point, they were regulated under the Interstate Commerce Commission. Um, Insurance, endowments, annuity contracts, if the states regulate them, which they usually do. Securities from reorganizations, and if you're just splitting stock or issuing dividends, all those are exempt. And there can be, that's just secure. These aren't transactions that are exempt. These are securities that are exempt because we're going to go now to the transactions that are exempt. So we've got two broad types of exempt transactions, what are called Regulation A transactions, Tier 1, Tier 2, and Regulation D, 504, 506, and 147, and we'll look at each one of those. So what are Regulation A securities? Well, these are if you are making offerings in less than 12 months. So what we allow you to do, if you do this in less than 12 months, if you're a Tier 1, okay, you can offer up to $20 million. Again, there's sort of the big boy break built in for you here. If you're a Tier 2, up to $50 million, which is a lot of money, but here the purchase of this securities is limited unless the individual buying it is an accredited investor, which basically means a big boy, a bank, an insurance company, a mutual fund, something like that. Now, in 2015, they raised that $5 million to a $50 million cap as part of, and again, this is Congress having that stupid idea that let's create an acronyms for everything, Jumpstart Our Business Startups, or the Jobs Act. Now, Regulation D, as I said, there's really three here. 504, non-investment companies selling under $5 million in 12 months. Private placement exemptions, private offerings of any amount not solicited or advertised with no more than 35 accredited investors, so big boy rule again. Or if you're doing it solely inside one state with no resales for at least 9 months, and that's Rule 147. All of these are big enough that they really don't touch on the common investor or the common person. So this is not going to be something you're going to see until you are of decent size. And this is just how complex the market can become. We do have certain rules that say any security or most securities can be resold without registration. Although you can trigger it if you're reselling stuff that was done under private placement, and these are going to be rules 144 and 144A. I give you the numbers of these rules, not so much that you have to go and memorize them. There's enough numbers running around in here that you don't have to memorize them, but just so that if you ever run across that, 144 says there's no restrictions if adequate public information, owned for at least a year, limited amount of sales, SEC notified, so that everyone's trying to stay above board. And selling or reselling to a qualified buyer who's got $100 million in assets. Again, the SEC is not going to look out for them too much. Well, what happens if you don't obey? What happens if you don't? Well, it's fraud. And fraud, of course, is a criminal act. Now, we can charge you with regular old fraud, depending upon what you did. Regular old state fraud, regular old federal fraud, although we're usually looking for a statute there. And there are a couple of defenses. One, any omission you make, anything you left out in your statements or registration was not important. Like, okay, I didn't tell you that the secretary of the board was from Austria, I said he was from Europe. Well, big deal. If the purchaser bought it but knew it was false, if the person who did the registration or the sale reasonably believed it to be true, that's called a due diligence defense. But if you can't raise those defenses, and it turns out that you intentionally tried to defraud people on the issuing of new securities, it's 5 years on $100,000. Plus, we're going to stop all sales of it, and any profits are going to be refunded. We're going to try to reset the whole thing. Now, that was just new. In 1934, they decided they needed to regulate all those stocks that already existed. So, think about the companies that are still around today that were around in 1933 or 1932. GM, Chrysler, IBM, AT&T, these are huge companies. Most of the insurance companies, MassMutual, New York Life, Hartford Insurance, these are big enough that we wanted some level of control over them, at least their stocks. So the 1934 Act, the Securities Act 1934, regulates any registration or exchange. It regulates brokers, dealers, and associates. Very large associates are called Section 12 countries. It also regulates proxy voting. All right, so what does it do? What are the rules here? And you're going to get sick of hearing 10b and 10b-5 in a second. So Securities and Exchange 10b-5 bans fraud, falsehood, or shady business practices. And it's very broad what those things are. But most critically, what are they watching out for? Well, 10b-5 is looking for insider trading. People inside the corporation that are profiting by using information they alone have to buy or sell a share of stock. So this is going to cover any of the directors, because they should have access, any of the major shareholders, because we're going to presume they have access, and any of the chief officers of the corporation. In fact, if you were to get a copy of the Wall Street Journal, printed or online, I guess, printed now, they have a section where, since this information is disclosed, if people on the board of AT&T are buying or selling, that's going to be published in the newspaper. It's going to be public information. You can't hide that stuff. Now, if I, a large investor, but not a major shareholder, bought or sold, no one needs to know. But if the person that owns the company or is the executive officer says, oh my God, I got to sell my shares of stock because he hears that the company is about to go bankrupt or something, we got to all know that. Once it gets out, you can sell your stock, but you can't sell it before. There is mandatory disclosures under 10b-5. You have to tell if there's any fraud going on in the trading. You have to tell me if you're changing dividends. So if you had a stock that people own because it gives you reliable dividends, like say Duke Energy, people buy Duke not because energy market's going to grow, but because it's a constant and they know they need certain amounts of capital and they're going to pay a decent dividend. If all of a sudden Duke said, well, we're not going to pay dividends this year, the Duke stock would drop dramatically. If you're going to sell all or most of your corporate assets, you got to let everybody know. If there's a significant change in the position, positive or negative, you got to let everybody know. If there's potential litigation against the company, and not something minor, someone sues because one phone that T-Mobile sold didn't work, but if all the phones weren't working, that would be big enough that that should be disclosed and the general public has a right to know. True insiders are your corporate officers, your directors, and your major shareholders. Tip or tippee theory is a little bit different. Now, this covers people who get tips and those who get tips from the people who get tips, or what are called, believe it or not, remote tippees. So let me give you a practical example of this. Martha Stewart. Martha Stewart got information from a corporate officer of a corporation. Okay, so that was an insider. So he disclosed that information. That's a violation. If he did it knowing that Martha Stewart was going to buy or sell, he's got liability, so does she. Now, she didn't actually buy or sell. What she did was she told her daughter, as I understand it, and I'm not an expert in this case, and I'll be honest, I've only read some brief summaries of it. But she told her daughter, and her daughter sold the stock. So her daughter was a remote tippee. So they are covered under 10b-5. And what happened was the FBI showed up and Martha Stewart lied to the FBI. She didn't go to jail for the violation of 10b-5. Arguably she could have. What she went to jail for was lying to the FBI. Of course, if you got that information out because of a tip because you stole it, you're also guilty of insider trading violations. Now, what happens? You're allowed to recapture all the profits that any insider makes from the sale or purchase within 6 months. It covers all those that are officers, directors, anybody that owns 10% of the stock. It covers whatever you can think of. Did they sell warrants? Did they try short swings? Did they try options? Did they try conversions? Any way they traded on that information, remember the mandatory things they got to disclose, that wasn't known to the general public, and they profited from, you can recover it. Now, the Private Securities Litigation Reform Act says insiders may make public predictions of profits and losses without danger. If in good faith they believe them to be true, that's fine. Good faith forecasts of profits are not covered under insider trading. So what happens? Well, you really have to show signature. Now, signature is one of my favorite words in the law. If I lie, but I don't really know I'm lying, it's not signature. Signature means you lie or you commit a crime usually. Here, you commit fraud with the actual intent to commit fraud. Now, that is required, okay? But signature is not required on 16b, which I'm going to talk about in a second. The criminal penalties for insider trading are 10 years and $1 million fines. Also, the SEC can sue you in federal court. They can recover triple any profits you make. And if a private party was the one who turned you in, they can have a bounty for that paid for discovering the fraud. All right, so I just was mentioning frauds, and I thought what I'd do here is put you up a slide so you could see what's classically a Ponzi scheme. This is a Ponzi scheme and how it works. All right, so at the top level here, the first person, the guy sitting alone at the top, he is the schemer. And what he does is he goes to the second level investors and he says, you give me money and I will pay you 20% return. And they go, wow, that's pretty good. Okay, so they each give him $1 million, we'll say. And sure enough, for that year, he pays them $200,000 interest. It's like, oh my God, this is great. Now, the guys below that here, and they say, wow, we want to get in on this. So the guy at the top says, well, You can either buy through the second level investors, or you can buy more from me. I will pay you 20%. Now, he isn't investing in anything. All he's doing is taking the capital that's giving him and paying back the return and skimming the rest. So in order for this to go on, he has to keep selling more and more and more. What's happening is the capital that's coming in is paying a fictitious rate of interest. As it gets more popular, more people get in, and the people at the top can keep getting paid year after year after year after year. Sometimes these Ponzi schemes go on for decades. Okay, so it's difficult for the Securities Exchange to monitor everything, and to be honest, they really have shown a distinct lack of interest in regulation. For example, Bernie Madoff, famous example, ran a Ponzi scheme under the nose of the Securities Exchange Commission for years. Under this scheme, he took in 65 billion, that's with a B, billion dollars, and he ran this for more than 20 years. And the interesting thing was, people came up and they looked at his rate of returns, particularly some mathematicians and some standard, and they said, this has got to be fraud. And they went to the SEC and said, this is fraud, something's going on here. But the SEC didn't believe those people. He'd been reported numerous times. It's really not to 2008, when really things are hitting the rails, that Madoff actually tells his son that it's all a scam, and his son turns him in. And he'd never really had any investments. He had just kept running this Ponzi scheme over and over and over again, and done quite well. Now, interestingly enough, a lot of that money was recovered because some of the people he paid, they clawed it back from them, or some of the people that were in the scheme. All right, we also have state security laws. States can regulate securities sold inside those states. Article 8 of the UCC, which has been adopted by all states, covers different types of securities. Generally, all these state security laws, they want disclosure, but because they're limited, it's easier to avoid these than federal regulations. All right, corporate governance. We'll talk about a little bit of this. The relationship between the corporation and the shareholders. If you think about it, you've really got three different groups. You got the shareholders, who in theory own the corporation. You got the officers who run it day to day, and you got the directors who manage it, who set general policy. But is that really how it works? Now, you can simply have a corporation just obey the letter of the law. But the problem is, as you start to separate ownership from control, you create problems, and we've seen a lot of scandals about this. So one of the things that we've tried to do in the modern or post-late modern capitalist state is create a closer relationship between the owner's interests and the people's running it, so that people don't loot the company they work for, or people don't do things short. We want to align the interests of the parties. So how have we done that? Well, one thing we've done is we've created stock options. We go to officers and say, we want you to benefit the shareholders. Right now, stock is selling for $10 a share. It'd be great if it went up to 20. Tell you what we're going to do. We're going to give you an option to buy stock at $15 a share in 1 year. Now, right now, it's worth nothing because stock's selling at $10 a share. But if stock in a year is selling at $20 because you've done such a good job, and you have a right to buy 1 million shares at $15, that's a $5 million bonus. Now, unfortunately, there have been a few problems here. This can create an incentive to inflate stock price and cook the books, often at the cost of the future corporation. So an example here would be in 2016, when there was that massive corporate tax cut and corporations got a lot of money back. One of the things they did with it was the people running the corporations had those corporations buy their own stock. Well, the reason that's really good for that corporation, good for those officers, is if they have a warrant, if they have a right to purchase the stock at a later period, there's now less stock, but the corporation is worth the same amount of money. Less stock, same money, each share worth more, stock goes up. And of course they profit. Another way you can do this is bring in people that are actually outside of the corporation and more interested in things like good corporate governance. You do want to audit. You want to get a accurate financial record. What's really going on? Now, this can be difficult because there were some scandals, and we won't revisit all of them, but there were some major scandals about auditing. The audit committee is a very critical part here. The audit committee is we go out and we find an accountant firm that is going to give us an accurate outlook of what the corporation, give us a snapshot in time and trends. Now, that's for an auditing company to do that, or for an accounting agency to do it. That's not a huge thing. They're going to get some money for that, but you know where they're going to get more money from is that corporation hires them to do more work. So you can kind of see where this is leading. What happened for a while was companies would come to an accountant firm and say, well, we're thinking of giving you a $10 million contract to run our regular accounting. But first, we're going to hire you to do a $100,000 audit. And when we get the audit from you, then we're going to make the decision if we hire you to do 10 million. Well, all of a sudden, if there's a questionable call in there, it starts to look like, well, why would we risk everything? Let's just give them a really happy audit. Compensation committees determine what to pay corporate officers because some of the things that have happened is, of course, there's all these incentives built in, and sometimes it can run away. I mean, there could be huge amounts of money. Right before the crash of '08, some people that were running these companies into the ground were collecting hundreds of thousands, sometimes millions of dollars or tens of millions of dollars in bonuses. Well, I said from time to time we see changes. In 2002, we had Sarbanes-Oxley, which generally really requires more and more disclosure. This was kind of because of a lot of these auditing problems cropped up. The key provisions here is that there is a oversight board that looks after these accounting firms, more protection for whistleblowers. CEOs are now responsible for the financial statements, so they have some personal responsibility, so they can't cook the books as readily. It's been somewhat successful. If you want to read some more about it, on page 811 of the 15th edition, they've got really a breakdown on a few more things about Sarbanes-Oxley. Investment companies are defined as companies that act for a number of smaller shareholders buying and selling. Everybody, if they think about it, knows what these are. These are mutual funds, and they are regulated by the Investment Company Act of 1940. This is very strict. If you've got 40% of your assets invested, you are an investment company. There's some exemption for banks, insurance companies. They're really regulated separately. Oil and gas, charities, regulated separately. Pension funds, regulated separately. And certain special types. But investment companies, we keep an eye on because, in particular, they've become so important to the American economy as the pensions have started to disappear and people are more and more reliant upon their 401ks for their retirement. Okay, last point to address here. Electronic presentation is taking the place of paper. It's pretty clear that there's more and more online offerings, and we have to understand that anything we put in to an online offering becomes part of that offering. So you've got to be really careful that any link you provide, any quote you give, anything you provide is true and accurate. Otherwise, you run the risk. We've also begun to see online securities offering by foreign countries and companies where the web allows transnational offerings, and the SEC asks for appropriate warnings about this, but really has very little direct enforcement power, particularly if the actual market is located elsewhere. And right now you used to have an extremely centralized market. Primarily, you had just two markets: the American and the New York Stock Exchange. But with online, there's a ton more of them out there. So it's a brave new world. But that's a quick outline in about 35 minutes or so of this chapter. And that's really going to round out everything that we have to talk about with the corporates. And we are going to move on now to, I believe, administrative law. All right, you all have a pleasant evening, afternoon, or morning, whichever it'll be. And I will talk to you shortly.